Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Fiserv, the financial technology infrastructure running quietly behind 1 in 3 U.S. banks.
Fiserv was incorporated in 1984 in Milwaukee, Wisconsin as a data processing service for smaller financial institutions that could not afford to run their own technology departments.
For most of its early life, Fiserv grew by acquiring community bank technology vendors, becoming the dominant core banking processor through relentless consolidation of fragmented competitors.
The 2019 merger with First Data was transformational. It folded in the Clover point-of-sale platform and Carat Enterprise Payment Suite, expanding Fiserv deep into the merchant-facing side of commerce.
Today, Fiserv operates 3 segments. Acceptance is the merchant-facing business. Clover, Carat, and the broader payment processing infrastructure serving retail, restaurant, and e-commerce merchants globally.
Fintech is the core banking and digital banking platform business. This is where banks and credit unions run their deposit systems, loan origination, and account management on Fiserv software.
Payments is the card and account-to-account transfer layer. Debit, credit, and prepaid card processing, bill payment, electronic billing, and peer-to-peer money movement for bank and credit union clients.
Clover deserves special mention. It has scaled to over 1 million active small business locations, processing north of $350 billion in gross payment volume annually.
The economic moat here is deep. Core banking systems are embedded in bank operations across multi-year contracts. Switching means replacing software that touches every account and every transaction.
Adjusted operating margins run around 38%. That reflects high software content and recurring transaction fees that scale with volume rather than requiring proportional headcount growth.
Organic revenue growth has sustained around 10% annually as transaction volumes grow, and Fiserv layers software-based value-added services on top of its core processing relationships.
Mike Lyons took the CEO role in May 2025 after Frank Bisignano left to lead the Social Security Administration. Lyons joined from PNC Financial Services Group, where he served as president, bringing over 30 years of financial services experience.
Fiserv does not pay a regular dividend. Free cash flow is deployed towards share repurchases and strategic acquisitions that extend the product platform and deepen the network moat.
Competitive peers include FIS and Global Payments on the financial technology side. Smaller fintech challengers like Stripe and Toast compete in specific verticals, but lack Fiserv's breadth.
The network reaches over 10,000 financial institution clients and processes on the order of $3 trillion in payment volume annually, scale that smaller competitors cannot economically replicate.
The primary risk is technology disruption. Cloud-native banking platforms and embedded finance players could gradually reduce the switching cost that makes Fiserv's core banking business so durable.
However, bank technology modernization cycles are measured in decades, not years. Regulatory constraints and data migration complexity protect incumbents like Fiserv from rapid competitive displacement by newer entrants.
For long-term investors, Fiserv is a technology compounder that sits inside financial services without credit exposure. It collects transaction fees whether the broader economy expands or contracts.
That is the company chapter for Fiserv. Infrastructure-grade technology, recurring revenue, and a payments platform compounding at scale. Now let's get into the quarter.
The numbers are fully loaded. The quarter is ready. Time to get into the results.
Fiserv beat earnings expectations in Q1 2026, but missed on revenue, and the stock fell more than 9% pre-market. Adjusted EPS of $1.79 beat consensus of $1.57 by 14%. But revenue declined 2% year-over-year, organic revenue fell 4%, and adjusted operating margin compressed sharply. New CEO Mike Lyons emphasized execution mode ahead of a May 14th Investor Day. This is Charged Alpha. Let's break it down.
For context, Fiserv carries a market cap near $30 billion and trades at 7 times forward earnings after the post-print decline. The business operates 2 reporting segments, Merchant Solutions, which includes Clover, and Financial Solutions, which includes core banking. The headline question Wall Street is asking, can the new CEO restore growth?
The headline beat had layers. Adjusted EPS of 179 landed 14% above consensus. But that beat was driven by below-the-line factors, lower interest expense and tax benefits, rather than operational strength. Revenue of $4.675 billion missed expectations of $4.73 billion, and the year-over-year revenue trend turned negative.
The segment composition tells the story. Merchant Solutions revenue of $2.37 billion was flat year-over-year, with organic revenue declining 1%. Financial Solutions revenue of $2.30 billion declined 5%, with organic revenue down 6%. Both segments are running below the company's longer-term growth ambitions.
The most concerning data point was margin compression. Adjusted operating margin came in at 29.7%, down from 37.8% in the prior year quarter. That is more than 800 basis points of compression. Merchant operating margin fell to 26.4% from 34.2%. The operating leverage that underpinned the bull case is reversing.
Free cash flow was $259 million in the quarter, down from $371 million in the prior year period. Cash conversion deteriorated alongside margin compression. The cash generation trajectory matters because Fiserv has used free cash flow primarily for share repurchases, and a smaller cash pool means less buyback support for the share price.
Within Merchant Solutions, Clover was a relative bright spot. Value-added services revenue grew 18% year-over-year, driven by software attach and lending capabilities. Management announced 27 new bank merchant referral partners and a major partnership with Western Alliance Bank, which carries over $90 billion in assets.
Within Financial Solutions, Fiserv added several core banking wins this quarter, including Ocean First Bank, Nicolate National Bank, and Trulient Federal Credit Union. Finxact, Fiserv's cloud core banking platform, received industry recognition as Best SaaS for FinTech. But these wins were not enough to offset client mix shifts and broader segment softness.
International results weighed on the quarter. Argentina inflation deceleration and lower interest rates compressed reported revenue, though management indicated the impact was largely offset by lower interest expense at the corporate level. The Argentina dynamic has been a recurring theme. Currency and macro volatility complicate the underlying growth narrative.
New CEO Mike Lyons took the role in May 2025, succeeding Frank Bisignano, who left to become Commissioner of the Social Security Administration. Lyons came from PNC Financial Services, where he served as president after running corporate and institutional banking. His background is banking client-side rather than payments operator.
Lyons used the call to introduce what he called the One Fiserv Action Plan. Specifics are reserved for the May 14th Investor Day, but operational metrics he highlighted include client inquiry resolution times down 27% year-over-year and high-impact incidents declining nearly 60%. Early operational improvements, but the strategic reset is still to come.
Capital return continued through the quarter. Fiserv does not pay a dividend. Share repurchases are the entire return mechanism. With free cash flow running below prior year levels, the pace of buybacks may moderate. Total debt of $29 billion against $26 billion of equity makes the balance sheet leverage notable.
Valuation has compressed materially. Fiserv now trades at roughly 7 times forward earnings, a level typically reserved for declining growth franchises. Price to sales sits at 1.5. EV to EBITDA approximately 12 times. The dividend yield is 0. Beta of 0.8 reflects the historically defensive nature of payments processing.
Wall Street's positioning has turned cautious. Consensus rating is hold. The breakdown is approximately 9 buys, 25 holds, and 1 sell. The average price target sits near $82. Several firms, including JP Morgan and Bank of America, moved to neutral or equal weight in the months before the print. The post-earnings reaction may trigger further target cuts.
Forward EPS for 2026 is consensus $8.15 per share, within the management guidance range of $8 to $8.30. The full-year guide was affirmed despite Q1 softness, implying acceleration in the back half. That setup raises the bar for Q2 and second-half execution to validate the guide.
The bull case rests on 3 pillars. First, Clover and value-added services. 18% value-added services growth and the Western Alliance partnership demonstrate the platform's pull on banks. The Clover business has structurally higher growth and recurring software economics than the legacy core banking business.
Second, the One Fiserv Action Plan. Mike Lyons brings an outside perspective from PNC. The May 14th Investor Day will outline specific cost reset and growth reacceleration targets. New CEO transitions historically create catalyst events, both for recuts and for credibility reset. Investors are giving Lyons the benefit of the doubt for the first quarter.
Third, valuation reset. At 7 times forward earnings, Fiserv trades at a significant discount to its longer-term average and to peers like FIS and GPN. Even modest stabilization in revenue trends could produce meaningful multiple expansion. The downside protection from valuation alone has improved materially.
The bear case starts with the revenue trajectory. Organic revenue down 4% at the consolidated level, and financial solutions down 6%, point to either market share losses or a structural slowdown in core banking spend. If client renewals continue facing repricing pressure, the segment may not return to growth at all this cycle.
Second concern, margin compression. 800 basis points of operating margin decline is not a noise quarter. It reflects real cost-revenue mismatch. Recovery will require either revenue acceleration or significant cost takeout. The May 14th plan needs to credibly address both, or the margin reset becomes the new baseline.
Third, leverage and capital return. $29 billion of debt against compressed free cash flow tightens the buyback math. If the operating environment does not improve, Fiserv may need to slow repurchases to maintain leverage ratios. A reduced capital return profile would weigh on the multiple further.
Fiserv's competitive set spans payment processors and core banking technology providers. FIS, the closest comparable, operates similar acceptance and core banking businesses. GPN, Global Payments, is the merchant-focused peer. Visa and MasterCard sit in the network rails and trade at premium multiples for higher growth. Paychex, is the small business payments and payroll comp.
Versus FIS, Fiserv has historically traded at a premium for growth. That premium has compressed materially. Both names now trade in the low double-digit forward earnings range. The choice between them comes down to which management team can stabilize revenue first. Both are mid-transition with new strategic plans.
Versus GPN, Fiserv carries more financial institution exposure and less pure merchant-facing revenue. GPN has been undergoing its own reset, including portfolio realignment. Both face the same secular question, whether scale players in payments processing can still grow above the rate of card volume.
Options activity around the print was cautious. Put-call ratio above 1 reflects elevated put buying. Implied volatility expanded post-print despite the headline EPS beat. The options market is pricing further uncertainty into the May 14th Investor Day, signaling investors are not yet convinced the strategic plan resolves the growth question.
Bottom line on Fiserv, the EPS beat is real but driven by below-the-line factors. The operating story is more difficult. Revenue declined, organic growth turned negative, and margins compressed sharply. New CEO Mike Lyons inherits a transition. The May 14th Investor Day is the next catalyst.
For long-term investors, Fiserv at 7 times forward earnings carries a meaningful discount, but the franchise needs to demonstrate revenue stabilization before the multiple expands. Track Q2 organic revenue growth and adjusted operating margin recovery. The May 14th plan is the credibility reset event.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.